Hi, everybody. This is Nat Tamariz back with the Raise.com Top Capital Raiser Show. And today I'm joined by a fantastic guest. His name is Seth Bradley. And Seth is with a portfolio of firms that he runs. And one of the main firms he focuses on is Raise Law, which is a securities firm that assists real estate operators, GPs, and people in the real estate world to prepare their offerings compliantly so that they're able to legally and compliantly raise capital. You know, as Seth is a extremely experienced securities attorney, IT experts, an entrepreneur. We're going to have a wide range of discussion about what's up next for the future of capital raising in real estate. So, Seth, it's amazing to have you here.
Absolutely, brother. Natu, thanks so much for having me on the show.
Yeah, no problem. So, it's not every day that you talk to an attorney that, an attorney that knows how to actually do business and knows how to work on getting deals done and build all these platforms. So very refreshing. So yeah, if you could help us kick things off, can you tell us how everything started when it came to, Raise Law and all your other firms? How did it start? And how can people, get to know a little bit about how everything originated and where things are going?
Absolutely, man. And I'll try to be quick because I'm going to take it back a little bit farther because I think it kind of fills in the gaps a little bit. Yeah. But I didn't come from money. I didn't come from real estate. I didn't come from finance, investment banking, all these sorts of things. This is all relatively new to me when I got started. My dad's a retired coal miner. My mom's a retired grade school teacher, grew up in rural West Virginia. Trading time for money was just the only thing that we knew, right? A lot of us out there are doing that with our W-2s, and we're trying to figure out how to get away from that. And that's why a lot of us have turned to investing in real estate and business. And for me at the time, though, growing up, it was like, well, what's the best thing I can do to trade my time for money? And in my mind, it was to become a doctor. So I did that whole thing. I actually went to medical school for a year and a half before dropping out in my second year because I just could feel it. It wasn't for me. I knew it wasn't for me. Entrepreneur at heart. Still didn't figure it out that quick, man. I ended up going to business school, getting my MBA, and then going to law school and getting my law degree. And I did really well there. So I ended up getting a big law firm job out of school, started working in real estate and securities in my practice. And luckily, or whatever you want to call it, got exposure to, these big real estate developers, right? They were our clients. So they're raising capital from investors. They're buying these huge apartment complexes and retail shopping centers and all these sorts of things. And even though at the time I didn't realize it, that's where I wanted to go, right? Like I looked at that and I said, most attorneys don't look at the deal that way. Most attorneys say like, hey, I'm an attorney and that's all I do. I'm going to get really good at this and, keep me kind of in my lane, right? In my services lane. But for me, I've always been an entrepreneur. I've always wanted to be kind of the man on the other side of the table that's owning the assets, raising the capital, doing those things. So luckily I got exposure to those big deals early on. So even though I started investing in real estate on the small side, I house hacked into a duplex with my wife and then started fixing and flipping single family houses, worked my way up to small multifamily, bigger multifamily. And then I started passively investing in syndications and then eventually started raising capital for these deals and got to the point now where, we have about 90 million in assets under management still, even though we haven't bought anything since the end of 2022 when the interest rates spiked up. We're kind of just waiting to see, where the dust settled, and a lot of folks got in trouble there. Luckily, we've done pretty well. But in the meantime, I launched my own boutique securities law firm, Raise Law, and joined a company called TribeVest, where we kind of do the same thing. TribeVest isn't a law firm, Raise Law is, but TribeVest does do fund setup and administration, but very niche product. So it's an SPV fund of funds. So if you're raising capital for somebody else's deal and their syndication or fund, then TribeVest is a fit. Anything else kind of outside of that narrow box, we can handle at Raise Law. So if you're setting up a more sophisticated fund or syndicate, or you're closing on some commercial real estate, we'll represent you on that side.
Oh, amazing. So sometimes my audience is a little bit confused about a fund of funds. And sometimes, because in the business, you have 5 different definitions for the same thing. So walk through people. Yeah, if you could just help people understand, like when you say fund of funds, what exactly you mean so they can conceptualize.
For sure, man. Folks that are like new to the industry, they can't even understand what we're saying, right? Like they come in and like, what are all these terms and acronyms? And it gets even worse because like you said, people will use the same term for different things. So you have to actually ask them, like, what do you mean? Tell me how you're using that word. When I say fund to fund, though, it is what it is, right? It's a fund to fund. You create your own fund and you take the aggregate capital that you collect into that fund and invest in another fund or another syndication. And that's the key there. So you basically got two securities, right? You've got your fund that you set up, and then you're taking that capital and investing in somebody else's fund or syndication, as opposed to the other way around, which would be you take your capital and invest directly into the asset. So you're buying the real estate or buying the business, whatever that looks like. But instead of that, you're actually buying membership interests or shares into another company that's actually buying the asset, buying the real estate, buying the business.
Okay, makes a lot of sense. So, yeah, because I mean, on our side, we see people, just for context, a lot of what we do is on the mergers and acquisition side, business acquisition side lately. But we see some people, so I guess stage one, they own their own real estate. So kind of like you when you were starting, stage one, fix and flip, they own their own real estate. Stage two, like maybe they get a lender and they get a little bit more leverage. Stage three is, okay, there's an equity gap. I want to buy that multifamily deal and then I don't have the equity. So I would, issue a 506C Regulation B, or even 506B if I have a personal relationship, and try to find some accredited investors to partner with me to, so I own that asset. So that's the asset that I own. So you're saying that this stage is, okay, I have another person's deal that I want to raise money for, instead of it being my asset that I own. Is that correct? Just to make sure.
Yeah, that's correct. And you're seeing more and more of that nowadays. So if you were to rewound this to, let's say, 5 years ago, these same folks that are doing the fund of funds were probably co-GPs, right? Like we used to call them co-GPs. We still call them co-GPs, but it's kind of become a thing that, something you don't necessarily say, because you're either a GP or you're not. There really shouldn't be this other role called a co-GP, because essentially what it turns out to be is that you're just raising capital and you're not really doing anything else. And that's illegal. That is non-compliant. There, that rule got abused. We're entrepreneurs. We push the cards. We always just try to keep taking a little bit more and taking a little bit more. And, a GP structure or a co-GP structure in its theory, it makes sense, right? Like everybody's pitching in, everybody's doing something, everybody's taking an active part in the deal. But what it turned into was like, hey, let's bring in 5 co-GPs. Let's bring in 10, 15. I saw like 20 co-GPs in some deals at a time. And it's like, well, what are you actually doing? Well, you're raising capital. And a lot of times you're getting paid just to raise capital, and you're getting paid based on how much capital you raise, which is even worse. That's transaction-based compensation. Can't do that unless you're a broker dealer. Just like I can't practice law unless I have a law license. You can't raise capital without a license unless you find an exemption. And that exemption is blown when you're just raising capital, charging transaction-based comp, and not doing anything else, not really taking another active role. But those folks now have come around, and now we found a more compliant way to do things, which is the fund of funds route. So you create your own fund. So you're your own issuer. You're the active partner in your own deal. And we're seeing that more and more. And we're actually seeing that too. A lot of lead sponsors that are the ones buying the assets, they're recruiting these folks. Yeah. They're recruiting these fund of fund managers to be part of kind of their team, inviting them to say, check out my deal. You want to raise capital for me. You're going to start your own fund of fund, and then you're going to invest passively into my deals. And folks are like, people are getting tons of momentum doing this. I mean, you're seeing like, these special events where they're getting wooed and taking them to nice dinners and, taking them to, football games and things like that. So it's kind of this whole new market that's developing.
When did you see this market develop? Because, one thing, I'm just going to get this out of the way. Like, I mean, you're a super experienced attorney. I mean, you're in California. You have your cap backwards, your guitar's on the background. Like, you're very unconventional, and you're more experienced than a lot of people that I've seen wearing a suit in New York City with a fake Rolex. So, right. So the thing is, what's my question is like, so when it came to finding this niche, how did you identify this growing trend Because I mean, it takes a lot of it's more than just a simple business here. It takes a lot of four-dimensional chess playing to come up with this, right? So because you definitely saw something many people didn't. So.
Yeah, I mean, it came down to, the SEC was actually cracking down on this a few years ago. So they were examining these sponsors that were abusing this co-GP kind of rule or this structure. And people were getting interviewed, and eventually not too many people actually got in trouble for it, but they did get interviewed by the SEC. They were getting questioned. They brought their co-GPs in, things like that, to interview them. So it got around. So this is a small industry, really, when you get into it, Natu, that everybody knows everybody, and everybody found out about that. Yeah. And they said, well, shit, what do we do? Right. Because we still need that capital. We still need this place for, capital raisers to be part of the deal, because lead sponsors maybe are trying to scale and they're having trouble raising all the capital themselves. So what's the answer? Like, what do we do instead of this co-GP structure? And the answer has actually always been fund of funds. Fund of funds is not new. It's been used in private equity for decades, right? But it hasn't necessarily been used in this industry in this way. Because it's expensive, right? It's expensive, it's time consuming, it's complicated. You have to find all these things that the lead sponsor used to do for you. You have to find a securities attorney, you have to find a CPA, you have to pick an investor portal, you have to do all the simple things like open a business banking account and file for your LLC and get an EIN number. All the things that the lead sponsor used to do for you, you have to do yourself now. And you have to form your own fund. So that's expensive, right? You get your own securities attorney. Maybe they're going to charge you $15,000 to, when I worked at a large law firm, we used to charge $75,000 to $100,000. So anywhere from $15,000 to $100,000 plus to set up this fund. It's expensive, it's time consuming, it's complicated. And for some of these folks that are just raising, $500,000 to $2 million per deal, it's like, it doesn't even make sense, right? It's not worth, the juice isn't worth the squeeze. But that's where I saw a gap in the industry. And luckily, I was actually speaking at an event with the CEO of TribeVest in, when was that, July of 2020, I want to say 2023. And he was trying to pivot his company from a group investing platform, which is traditionally what TribeVest used to do, into the capital raiser side, right? Like all these folks that were putting these groups together, these group investments together, started saying, look, I'm doing all the work, right? Somebody in that group is doing all the work, getting all the people together, organizing them, and they want to get paid for their services. Well, how can you do that? Not through a group investing platform. You can't do it that way. So how do you do it? We're getting into the securities world. We have to do something else. So maybe it's a co-GP, maybe it's a fund of fund. Obviously, we already talked about people moving away from the co-GP route at that point in time. So I said, look, Travis, like if you want to get into that world or into this world, fund of fund is where it's going. We just got to figure it out. So flew out to Columbus, whiteboarded, and we built the product and made it cost effective, economical, fast. You can spin these things up in 5 business days. Once we're fully built out on our tech platform, it'll be an immediate thing. So you'll be able to just fill it out yourself and boom, you're going to have an offering ready to launch immediately. But for now, 5 business days is still pretty damn fast.
It is. And so is that including like legal review, or is that like before legal review, or how does it work?
That's right. So on the legal side, we do file, let's say for your Form D, so your 506B, your 506C exemption, we file your blue sky notices and pay your fees. Those are passed through at cost. And then your offering documents, right? So the offering documents, everybody's working on this, right? You see, there's a few of them out there, Fund Launch, Bridger Pennington, who I've met a number of times. There's a few other folks that I've met with that are building something similar and asked for my advice on how to build it, right? Like, how do you build these automated offering document sets? People have done it in simple documents like purchase and sale agreements, estate planning tools, things like that are much more simple documents. But as you can tell, it's much more complex to try to do this with a set of offering documents, because we're talking about probably 120 page document across the PPM and the operating agreement and the subscription docs. But what we've done at TribeVest is really simplified that. So with a fund of fund, it's a lot more simple, because it's really just, we leverage the target deal. Because we're investing in another syndication or another fund, that attorney and that law firm has already done a ton of the work already, right? Like they've already, looked at the asset, looked at the business plan, looked at the geography, all those disclosures and risks and things that are very specific to the deal have already been fleshed out by a law firm, by an attorney somewhere, right? And we use those target deal docs. We actually just attach them as exhibits to our fund-to-fund docs. So our docs are very simple, templatized. Again, TriVest is not a law firm, so we can't give you legal advice or counsel. So it has to be highly templatized. So we've simplified that, distilled that down to make it really simple, and just given our fund managers, the basics, but really all they need, right? They don't need this really complex waterfall structure or to charge 20 different fees or have 10 different membership classes. If you cover if you can charge an upfront, an annual, and a back end fee or promote carried interest, whatever you want to call it, give your investors a preferred return and a profit split. What else do you need? I mean, that covers probably 90% of deals anyways. So unless you want to kind of muddy that up, it works out.
Yeah, no, it's brilliant, especially when you're looking at reaching people at scale. Because I mean, you mentioned the deal sizes, and we do, funny enough, similar deal sizes as well. Below, we have the 40, 50 millions here and there, but really below 10 million. So because I mean, like, how do you see from the risks perspective? Because you mentioned Bridger, and like at the time of the recording, there are a lot of platforms coming out with chat first interfaces, instant document formation. But isn't it one of those things where it's like you're building a bridge where if there's one thing that's wrong, then it's disastrous? Or is it because you're leveraging the existing, I guess, the original fund, the original documents? That's why you don't really have some of those that pressure on you, and it's not a law firm as well. So are there like just a ton of disclaimers telling them, hey, go find your own lawyer? Or basically, how do you mitigate risk at scale? Because even if there's like 0.001% error rate, and then you scale, let's say you scale to like 10,000 users in the future, or I don't know if you're already there, but just how do you mitigate risk, especially for people who are really concerned about this type of stuff?
Yeah, I mean, there's risk in everything, right? I mean, there's risk when you're building a business. There's going to be risk. It comes down to what's your appetite for it. With TriVest, we do highly recommend that you engage with your own securities attorney, right? We say, here's our templated documents, and they are templated, and we disclose that, and we say these are not, scrutinized, customized per deal, other than kind of the basic facts, right? You tell us, this fund, we use what's called a fund manager worksheet or intake form. And you give us the factual things like addresses and name and entity and, what you want to charge for a split and a pref and those sorts of things. And it's really just data input into a template, right? Now, if you want to take those templates and you want to get them scrutinized by a securities attorney, you want to get them approved by a securities attorney, you want to make sure that, the legal positions that those documents take, then we highly encourage our clients to go out there and get them looked at by their own securities attorney, because we make it very clear that we are not a law firm, because we're not. So, that's how we deal with it at TriVest. And again, like you mentioned, we leverage those target deal docs substantially, right? So those very specific risks and disclosures that have to do with the target deal, and with ultimately, even though the fund-of-fund investors are investing in a fund-of-fund, that fund-of-fund is only investing in one specific predetermined target deal. And those risks and disclosures are disclosed to that investor through those exhibits. So, we're covered on that side. The problem I've seen with some of these automated offering document tech companies is that right now, a lot of them are drafted from scratch each time. So they'll say, okay, here's all the parameters we want. Very similarly, right? Like a deal intake form of some sort. Here's all the facts of the fund that we want. Here's what we're buying. Here's, the real estate, the address, like all the facts. And then you just hit go, right? And the LLM, whatever's in the back, spits out a full set of offering documents, and they look great, right? Like just visually, they're going to look great. But I have found that the ones I've looked at so far, and this is going to get better and better and better, of course. But right now, the ones that I've seen so far, they draft them from scratch. And that's really difficult, because it's going to spit out 120 pages of something that you don't know if it's good or it's not. And who's going to check, every single word of a brand new document every single time? It's not even templatized, right? Like it's just a brand new document every time. And then if you bring that to a securities attorney, they're going to be like, no, there's no way I can take on that kind of malpractice liability by approving this brand new set of docs that I've never seen before, because they're going to have to read every single word, and they're not going to do it.
Exactly. Yeah, that's the thing. And but how about the workflow? Because I found, so on ours, just for context, I don't know if you've seen this, but on our side, we find that, especially some of the more affluent clients, they are very like DIY or DFY, they're very like white glove. They want everything done for them. And then like, even just to send an email or to read an email, sometimes they're like, oh, call me, right? So not for all clients, but there's a subset of clients that seem to be very in a need of people like human labor specifically doing stuff for them. And especially in this real estate business, some people are very like low tech, and they're very like, hey, call me. Hey, I'm at the field right now. I can't go on the computer, So are you targeting that subset? And what are you seeing in terms of the workflow, or are you targeting more people that are more DIY? They'll do everything themselves, because sometimes you can get some people to fill in a form. I don't know if you found, but sometimes it's like pulling teeth depending on the person.
Yeah, I mean, I feel like we've made the setup as easy as possible. So if you are kind of that do-it-yourself person, and you want to get it done really, really quickly and help kind of propagate it forward, then we work with that. But we also are. So we used to use the term white glove at TriVest. We used to say we're a white glove service, because we would have an account manager, a human being assigned to you, and kind of walk you through every single step. Now, that is not really scalable unless you scale it with a lot of people, and that's a pain in the ass. So we're trying to get away from that, honestly. But for now, we still have that in the background. So if you want to pick up the phone and call somebody, you want to email somebody, there's a human being on the other side, a representative from TriVest that can give you guidance and say, yeah, this is exactly what we're asking for. Oh, tell me about your fund, and I can help you kind of walk you through the steps, step by step, that sort of thing. Because we are dealing with securities. We're dealing with something serious. We're dealing with other people's capital. So we want to make sure that we get it right. So we do have humans kind of backstopping everything at this point. So whether you're a do-it-yourself type of person, or you kind of want more of that white glove, human to human service, we offer both.
Okay, that makes sense. Yeah, because like for what we've seen on the M&A side, it's like there are a bunch of forms that people fill out, if they want to buy a business, to prepare some of the draft documents. And many times there's not an equity need, but if there is an equity need, there are documents that get filled out. But probably 80% of the time, people during the onboarding call, we just kind of do it for people anyways. But that being said, somebody that works with you, is it a one-time engagement, or are there yearly recurring fees, kind of like Angelus, where it's dependent on different add-ons you have, or yearly renewals? How does that all work?
Yeah, so I think one differentiation that we have in our pricing is that we do offer fund administration. So the setup, and we're very transparent about pricing, is $5,000 to set up. It's $2,000 a year for fund administration. And the fund administration can get very expensive. So $2,000 a year is practically nothing. I mean, it's a drip in the bucket. And it includes your accounting and K1 services. So even if you went out to a CPA and had to get K1s for your investors, you're going to pay at least $2,000 a year just for that piece alone, let alone for your investor portal, which at a minimum, if you go out there to the marketplace, you're going to pay probably at least $500 a month for that. So that's another $6,000 a year. So those two things alone cover your $2,000 a year. Now that's only up to 10 investors. So if you have 10 investors or fewer, 2,000, and then we scale with the number of investors. So for every 10 investors, it's another $1,000 a year. So it just depends. It kind of scales with your business, with the number of investors, as opposed to, let's say, your EUM.
Yeah, that makes a lot of sense. So, but investor number 11, then what's the next hurdle?
We do have $500 increments. So 11 to 15, we do 2,500. 16 to 20, we do 3,000.
Okay, I mean that's pretty reasonable. So
yeah.
So okay, so you have that. What are you seeing in terms of, like, I guess the trends right now? Because right now, yeah, you have this platform, and you have a good case and everything. But what are you seeing in terms of what's coming up in the next 5 years? Because, for example, AI, when it comes to text, for example, it seems to already be there if you prompt it right. But when it comes to voice, it's not there yet. So, what are you doing to stay ahead of the curve? And do you even need to be ahead of the curve? Because you have law firms that are still using fax machines, and they're doing pretty well. Yeah, but so I'm really just curious on are you looking to be like ahead of everything, or are you okay with bringing on the laggards, and you think everything will still be well? I'm curious on what you think when it comes to how AI may or may not disrupt the business that we're in.
Yeah, I mean, it's tough to predict, right, man? I mean, we've got $65 trillion are going to get invested into the private markets before 2032. It's insane. Right now, I believe we're sitting at 15, and 5 years ago it was at 10. So it's going to expand exponentially. I mean, you've seen kind of the enthusiasm for it, even though we've been kind of in a down commercial real estate market the last few years. Private money is there, and you're seeing it starting to turn. And over the next 7 years or so, 6 years or so, it's going to go through the roof. So somebody's got to take advantage of this. And because we have AI, because we didn't have, during the last real estate run up that ended the end of 2022, we didn't have AI. We're kind of living in it now, and we think that we use it every single day we don't even use Google anymore, right? 4 years ago, we didn't have that. So now on the next real estate run up, on the next bull run, we have AI, and maybe blockchain is going to circle back around too. Like blockchain was the darling maybe 7-8 years ago. You combine those two technologies with a real estate bull run and all this money that's going to get invested in the private market, it's going to be insane. So you do need to stay on the forefront of it. Now, do you need to have 5 separate computers that are running Claude on each one? I've seen people do that, and then you're trying to keep up with everything. I think some of that's a little bit of a waste of time, because it's changing so fast that as soon as you kind of build your system around their systems, you're already behind, right? They're spending hundreds of billions of dollars on this stuff. You're not going to be able to keep up entirely, but you need to keep up long enough to not get left behind as well. I mean, think about people with their iPhones. Whenever you skip a few generations, when you jump back into it 4 or 5 generations later, you're like, what the hell am I looking at here, right? You have to keep up with it, or you're going to get left behind, because if you try to jump in from ground zero a couple years from now, you're going to be lost. You're going to be like an 80-year-old walking around and saying, oh, what's a computer, that kind of thing. So you need to stay on it, and you need to utilize it for your business. I know you use it for yours. I use it for mine. Be aware of how you're going to get replaced, right? I'm a transactional securities attorney. I am well aware that at some point they're going to be able to produce offering documents that are really, really good. I mean, it's almost there, but it's not quite there yet. So I need to figure out, where's my value outside of that, right? It's deal structuring, it's counseling, it's, hey, this is your specific situation. How do you raise capital compliantly without getting in trouble? I mean, all those things, that's a human element that won't be lost, right? So you just got to think about, how you can add value outside of maybe, things that can function on AI, and also how you can exponentially use AI to grow your business right now.
Yeah, no, I totally agree, because if I'm listening to somebody, if I want to find out the truth, right, I'm not going to just go and ChatGPT. I will for ideas, but I'll probably talk to an attorney if it comes when it comes down to it, because, for example, some of our deals, there's some types of structures that we haven't seen before. So I'm going to trust the attorney that I've known for 13 years, who's a partner. It's $1,000 an hour, but at least I know him. I'm going to trust that instead of somebody that instead of just an LLM that scrapes off Reddit. You know what I mean?
Right.
So, there's that. And what are you seeing in the law firm side of things? Because is it more just because there are a lot of aspects that you can help out? So is it more just fund formation, or is it you help people if they get a demand letter from somebody? How is the law firm? What are the main issues your clients are seeing on the law firm that you're helping people solve?
Yeah, Raised Law is squarely a transactional law firm. So we help with your filings, help you with your organizational structuring, keeping you compliant while you're raising capital, draft your offering documents, do all those sorts of things with the, any kind of communications with the SEC and state commissioners. We are not a litigation law firm, however, but we do have partner law firms that handle that, and they only handle that. So there are boutique firms out there that will, I'll say boutique securities law firms out there that will try to handle both, and some of them do an okay job at it. But for the most part, these are folks that don't have that specialty like they should. So we prefer, like, we could handle some of that, at least some of the communications. If you start getting in trouble over something or you have an angry investor, and we'll help with that. Like, we will work hand in hand with our litigation partners. But those guys have been doing this for decades and decades and decades. Like, they're really good at what they do. So we're not going to step in and pretend that we're better than them. So we'll partner with them and we'll work hand in hand with them, because if we're the ones that drafted the documents, did the filings, advised you, counseled you, then they're going to need our input as well to help you through the situation.
It makes sense. So one thing about law, because we had a few new lawyer podcasts here. So when it comes to these transactions, so I mean, you see a transaction that is, let's say, the acquisition of like a 8-figure, 9-figure deal, and then you have a great relationship, you get a new client. How, like, I'm super curious, because okay, you have these engagements, so like, do lawyers ever take like part of the upside as well? Because I understand that there are a lot of I guess there's a lot of red tape preventing people from taking like commission and parts of the deal and equity and everything, depending on the situation. But is it just like an hourly thing, or like, is there something different? How do you must see a lot of deals. So how do lawyers in general take advantage of all the deal flow that they can get?
Yeah, I mean, typically they don't. So I would say, I don't know what the percentage is, but typically they do not. The vast majority do not. And most attorneys are not entrepreneurs. They are not people that, they're service providers, and they're W-2s, and they're people that like to just collect a paycheck. So the idea, and especially attorneys, because the idea of, additional risk involved, things like that, don't necessarily have a palate for that. But you can partner with your attorney, or an attorney can partner with you on a deal. They can get some of the upside. They can be in, maybe instead of, maybe they take a reduced comp that they would normally charge for the deal, and instead they take a piece of equity, right? You can do that, and you need to be really, really careful, because there are state bar rules about that specifically, because that does create a conflict of interest, right? It creates a conflict of interest because this attorney is representing you while also, maybe owns some equity in the deal itself. So it has to be disclosed. It has to be a written agreement that you agree to up front, and says, you're waiving this conflict of interest with your attorney, and here's why. Blah, blah, blah. And then you have to have kind of an agreement up front about it. So it must be discussed. And then, certainly you can do that. And I've done it in the past for myself as well with syndications and funds.
Okay. I mean, that makes sense, because just thinking back, the biggest fees I've seen for lawyers have been literally, like, let's say a regulating body has, they want to take somebody through some form of arbitration or something. And then I've seen like people say, hey, it's going to be 6 figures for us to work on this. Like, I mean, those are the biggest ones that I've seen, but I'm not a lawyer. So like, I guess it's good the way that they're versatile, because I mean, there's a lot of, there are a lot of deals that you can see in the business, right? So.
For sure. Yeah. And then, you can offer different things. I mean, I know in the past that, typically with like a syndication or a fund, a lot of the legal services are done up front, right? Like, once that initial offering is, especially with the syndication, once the deal is closed, once the offering is closed, there's a little bit of ongoing compliance and things that you need to watch out for, annual filing, stuff like that, but there's not a lot, right? But it just depends. You might have to engage with like a real estate attorney if there's commercial real estate involved, to review leases or things like that come up. So you could be, this general counsel type of role. And I've taken that role as well. and especially with funds. So funds do have a little bit more kind of ongoing administration. If you keep that offering open and you keep raising capital for, past the 1 year mark, things like that, it might make sense to have a lawyer on staff or general counsel when you get big enough, or, maybe some sort of, you might call it like a fractional general counsel, things like that. And that's where an attorney might make sense, is to be part of your deal if that's something that they would want to negotiate with you. But again, there's not too many out there that even want that.
Yeah, that makes sense. I mean, you're in California, so I guess you're really close to the mecca of technology, Silicon Valley. So, have you thought about applying some of the automations and systematization to Ray's law as well, or do you want to focus the tech on the TribeVest side of things, or is it
a little bit of both? I mean, right now, TribeVest is a tech-enabled platform. We consider ourselves fintech, SaaS company. And, eventually some of these manual things that we're doing in the background are going to be completely automated and on our platform. We won't have to have all these manual processes in the background. Ray's Law is more of a traditional law firm, not necessarily tech enabled, other than, kind of the basic things where we can provide a portal for you to, share your documents and things like that. But I'm just kind of watching the market right now. I mean, certainly I have the contacts and the people that would be able to build something. But again, I'm just kind of watching the market to see what happens, right? There are a few law firms out there that I'm watching specifically. I won't name names, but they are kind of staying at that very forefront, that cutting edge. And I'm watching to see what they do. I'm watching to see how it's received. And at the end of the day, the big thing for law firms right now is that you're seeing private equity get into the game. There's this kind of loophole that they found in Arizona, where basically you put all the assets of the law firm into a company, a separate company. So your IP, your marketing, your advertising, your staffing, all that kind of goes in this other company. And then you've got the law firm over here, because traditionally a non-lawyer cannot own equity in a law firm. So that's kind of the traditional rule. So what they've done is they've split the two pieces apart, and then they've tried to sell to private equity together. And you're seeing personal injury firms have some success with this and get some big equity multiples, which is fantastic. I haven't seen anybody do it kind of in the securities or real estate firm space, but I'm watching it very closely because that really interests me.
Yeah, I've heard something of that too. Because I was this is like a year ago or so. I was looking up who can own law firms and how, and I did see something like that. Funny enough. So
yep.
But you're mentioning multiples. And one, I think, inherent issue, if you can probably correct me, that I'm seeing with, so companies like yours and so on, so SaaS seems to be pretty much, I mean, obviously software as a service, but usually these multiples seem to be driven by the fact that there's really sticky retention, really sticky revenues. So the only form of stickiness I'm seeing in fintechs is really just, obviously workflow, something associated with a workflow, kind of like we interviewed, the fellow's name is escaping me right now, but we interviewed somebody who has a lending platform and then also administration. But I think one inherent issue of this business that we're all in is like everything's very transactional, where, I have one deal, one upfront fee. But I think the problem with that is that sometimes to increase the MRR or ARR, there has to be like some sort of recurring costs, such as administration. But aside from administration, I'm not really seeing much. But I'm not sure where I'm going with this, but basically, like, there's some businesses like accounting, high sticky multiples, super sticky, amazing. Sure. But then there's some businesses where the nature of the business itself, isn't really that sticky. So that's why what we've done is, for example, after we help people buy businesses, we loop them into an accounting firm to get that stickiness. But I guess so any insight into that? I guess you guys already have like the administration side of things, so I guess you guys are covered on that front.
Yeah, I mean, from both lenses, I'm thinking about that from the Ray's Law perspective. Yeah. And I'm have that same question. It's like, how can we create recurring revenue? Because right now everything is very transactional. It's okay, you engage us as counsel for your fund or your syndication or your commercial real estate closing. Once that offering or that deal is closed, there's a few fees here and there, but for the most part, it's done, right? So it's very transactional. Yes, we have repeat clients, so they're buying multiple pieces of real estate a year. but it's still transactional. It's one instead of, okay, you pay this much a month. So I am constantly thinking about that. I haven't solved it yet. Probably just more lines of business. We're talking about bringing in like title and escrow services, maybe insurance, things like that. So, that's to be determined. TribeVest is actually great with recurring revenue because once you lock in for our fund of funds setup and administration, those fund of funds last for the length of the target deal. And that's typically anywhere, probably averages 5 to 7 years. So they're sticky and they don't leave the platform because, as you know, it's really hard to leave an investor portal, right? And we have an investor portal. That's not all we offer, but we do have one. So it's really hard to leave because it's a pain in the ass and you got to bring all your investors over to another platform and all that. So it is actually very sticky. So I think we've only had 2 users ever leave the platform thus far, which is wild. We have like a 99% or 98% retention ratio. And so you're stuck there for, I hate to say stuck there like it's a bad thing, but you know what I mean? You know what I mean? But you are with us for the long run. You're with us for 5 to 7 years. So it's actually really sticky.
Yeah, no, that's amazing. Just for out of interest, we've been able to do that just mainly out of like after we close clients' deals because we're basically tech-enabled service, so we're not really as SaaS as on that. But when people buy the businesses, through our magical securities attorneys, we're able to take stake and also just like offer accounting. So that's the way around it. So it's kind of like driven to forcing us to have to actually be able to close the client's deals, or if it's a good client fit. And speaking about client fit, people watching this, they're listening, maybe they're interested. Who's the type of client that is a good fit for TribeVest? Obviously, Raise Law, if there's an issue like that they want it or a transaction want to get done. But obviously, you probably you know what a good client is, you know what a bad client is. What are they? Just so that people, the right types of people are working with you.
Yeah, really on both sides. Anybody that's raising capital, typically for real estate, but you can do it for private equity or roll-ups or anything like that. But typically, if you are raising capital, then we can help you. So we're a securities law firm at Raise Law, and on the side, we can also help you close your commercial real estate if it's associated with that, and TribeVest as well. So if you're the lead sponsor or the syndicator or the target deal fund manager, we help you build a program to bring in these capital raisers to raise capital for you, or we actually help the capital raiser themselves set up their fund of funds on our platform. So anybody looking to raise capital for their business, or it is their business, or for real estate or private equity, we can help you out.
Brilliant. So yeah, hey, we have a lot of things that are changing. We had speaking to the types of people that want to work with you, and then obviously going back to what we were talking about when it came to, the decline in commercial real estate market. We see in the chair, we had the change in the chair. What do we see happening I don't know, nobody knows, but what are you seeing in terms of the actual markets, in terms of potentially in terms of politics? We have this new chair, Kevin, and people are kind of people are not looking. The ZERP era is over. The interest rates are probably not going down. I guess that's what the sentiment seems to be. I'm not sure if it seems to be. What do we think is happening with regards to the real estate market here, really? And how can people benefit based on both situations, if it continues to decline or if we have a resurgence?
Yeah. It's interesting because I was one of the people that were saying, as soon as Powell gets out and Trump gets his new guy in, he certainly is not going to put anybody in there that's not going to lower the rates. I thought the rates were going to go down, and now we're hearing that they're not. We're hearing that they might even go up, which is crazy. So we'll see. I don't think we're going to get much help. Whether they go up, whether they go down in the near term, it probably doesn't matter because it's probably just like a little bit, right? They're probably going to adjust it 0.25 up, down, maybe with the next couple of quarters. So I don't think it's going to have a huge impact the way that we would hope that it would. So I think we just need to kind of look at the general market as it is. What I'm seeing out there is that some of these folks that have kind of punted these adjustable rate loans down the field are starting to come due. So you're starting to see banks take back some of these properties. Now, I don't think it's going to be this massive, huge, Robert Kiyosaki doomsday type of stuff, right?
Yeah.
I think, but you are seeing properties getting taken back from the banks, which, unfortunately for them, that's not good. But it is opportunity for others. And I am seeing people that have these relationships with receivers, with banks, with estate planning attorneys, places like that, that are getting access to these deals, and they're buying them for 50% on the dollar or 50 cents on the dollar. And some of these assets are nice. We're not talking about, necessarily like Class C workforce housing, things like that. We're talking about, maybe B, A- type of properties that are just really mismanaged by folks that probably had no business running them, buying them over towards the end of the last real estate cycle. Mm-hmm. And they're getting fantastic deals. So if you're a good operator and you can take over one of these properties that's, 40% occupied, but the bones are there and the market is good, then some fantastic opportunities I think are starting to come about. And that I'm going to start raising capital here again towards the end of Q3, Q4 this year. So because there are opportunities out there, I think this is one of those times where it's a great time to buy. And 5 years from now, we'll look back and say, damn, I wish we would have bought then. Yeah,
that's amazing. So I'm looking forward to it, really. And see, the thing is, I think the types of people that come to your platform and the types of deals, because obviously, you're incentivized to offer a good service for people over a long time. It's something that's of value. Doesn't that mean that they have to be successful in their deals, though? So, if somebody has a deal, they want to set up a fund, they want to set up and everything, and then the person is successful in raising capital for the, I want to say the original fund, because at first I used to think about actual fund of funds for the sake of doing a fund of funds, but now that you gave me the context, I understand that really it's just it's Code GP 2.0 basically. So yes, which is really interesting. So my question is, they have to be, so they're the successful type of fund of fund providers, because then that'll be the best type of person that will increase the LTV, they'll be the highest LTV customer. So yep. Do they come to you after they're when they're already successful, or because I'm going to assume that there's because if to have that high retention rate, they have to already be successful, no? And how does that work?
Yeah. I mean, all walks of life, I like to say. I mean, there are folks that haven't raised capital before, all the way up to people that have raised 50, 100, 150 million dollars in equity. We get them all. I would say that the financial commitment by itself is a nice little way to have a bar, a minimum bar, right? If somebody even though it's not that much, even though it's only $5,000, it's still a commitment, right? Like if you're a novice fundraiser and you're getting into the business and you think you're going to be successful, or maybe you think you don't, or you're not sure, right? You've got to make a $5,000 commitment up front and say, okay, I can do this. I'm going to commit $5,000, just like joining a mastermind or something, right? Like you make a financial commitment and then you're going to take advantage of it. So we see that people are trying their best because they want to at least extract enough value from that $5,000 they've spent, right? Compared to, I feel like, in the Code GP model 5 years ago, where you're just kind of brought into the deal. It's like, well, I'll try to raise, and then if I don't, then I don't. You can kick me out, that sort of thing. Here, you've made a real financial commitment to TribeVest or whatever platform or securities attorney that you've used. So you're going to do your best, your absolute best, to try to at least extract that much value back out by raising capital and being somewhat successful. Now, everybody's not successful. We see lots of people that launch and are unable to raise. It's harder than you think if you haven't done before. It's hard to raise capital, right? They see, people on YouTube and people with these masterminds say, "Oh, I've raised $1 billion or whatever." It's like, sure, maybe you have, maybe you haven't, but it's hard to raise capital, especially if you haven't done it before. You haven't had those conversations with investors. It's hard to do. It's hard to scale, but it's extremely lucrative. So if you get good at it, there's no better place to be.
Yeah, exactly. But it's so interesting because it's like, okay, so people have the skill and they want to raise capital and everything. And because I see some people have shiny object syndrome, or ADD, for lack of better words, in the sense of they'll go to try to raise capital and then, oh, I have a crypto deal in Zimbabwe, or I have a gold mine up in Alaska. Like there's always some story, right? Like 2 months, just in working hand in hand with the clients. So is it, so you see the 5K commitment, but what about I think the renewals, they're still doing that, as they're trying to raise money, or how does that work?
Yeah, they're still doing that. I mean, it's still $2,000 a year for the fund administration, but let's say that they didn't do very well, they didn't launch, they didn't raise any capital. Well, they're not paying the $2,000 a year, right? So,
Okay.
because that's just to administer the fund if you were successful. So if you had actual investors that invested in your deal.
That makes sense. Is there like, are there investment banks in your network as well that people can, or training or courses or anything in your network or in your portfolio of companies as well that people can go and be like, okay, I have my raise law for like in the future when I want to do a REIT or whatever, and hey, I have my TribeVest for just getting started. Is there like a coaching program to teach people how to raise money as well?
So we just developed one through TribeVest actually. Right now, I can't speak for the next one, but for this one, and I'm actually the trainer for it, I'm the coach. We charge $2,500, so it's really cheap. And actually that $2,500 goes towards your fund-to-fund cost, your setup cost, if you end up launching on TribeVest. So that's kind of like, think it from the business perspective and from their perspective, it's a great deal. For us, we want you to launch. So we'll give you that credit back if you complete the program and if you launch on TribeVest. So essentially the education will be free. And, from their perspective, hell, if you're going to launch a TribeVest tribe, then you might as well take the free education anyway. So it's a quick 6-week accelerator. We've done the first one. We had 31 people in the first cohort. We were aiming for 30, so we hit our goal. And the next one, we'll probably have 30 to 50 more, which will launch, I believe, September 1st. So we already have a waiting list going for that because we've had such a outcry for it.
Yeah, that's amazing. It's almost like an accelerator.
Yeah. Yep. It's an accelerator, 6 weeks. And the goal is to get you to launch. Like before the end of the 6 weeks, we're introducing you to deals, to lead sponsors. We're showing you how to pitch investors. We're showing you how to vet lead sponsors, showing you how to scale, how to grow your business, all the basics, like how you get paid, how your investors get paid, through the fund of funds. We call it a fund of funds waterfall. And, soup to nuts. So we're trying to get you to launch within those 6 weeks and even introduce you to deals and sponsors that you can have conversations with and potentially raise for. So, it's an accelerator. It's not your typical course because we're actually trying to get you to take action and do things and raise capital. And we've been doing great so far. We're already into week number 3 right now, and our students are already launching their fund of funds program.
Nice. So that's really good. Okay, so you thought of that case, and this is super productive. And I think when it comes to people that want to actually like raise capital for real estate or partners, it's almost like so I guess in the marketing world, you have some people that will teach people how to market for another agent, like I guess growth consulting, growth marketing. So it's like if somebody, it's almost like a bit like I hate to use this term. This is not what it is, but it's almost like a biz op. In a sense where it could be like at the bottom of the market where it's like, hey, you want to make your first, bucket of cash.
Yeah.
Learn how to do this. But for the people more upmarket, it's like, hey, here's a legitimate way to structure your deal so you can actually legally raise money for other people as a career,
Yeah, for sure. And I've thought about doing my own coaching consulting type of thing, but right now I'm really focused on growing the businesses. So I think it would be a distraction.
Cool. Yeah, well, listen. I mean, I think this was a really good, wide-ranging discussion. But I think, just before we wrap up, what's one, I guess, like anti-pattern or like just a recurring mistake or like what people that want to work with either TribeVest or Raise Law? What's like a super common misconception that people have, and how do you correct it? Because it must be annoying to kind of like somebody comes to you, they have the same false belief, and then you have to correct it. So if you can just guide the people here on a misconception that's really common.
Yeah, I mean, really simple. On the Raise Law side, so the securities law side, people are still really confused whether they want to launch like a syndication or a fund. I would say 5 years ago, everybody was doing syndication, right? Everybody was doing kind of these one-off. Everybody's buying apartment buildings. Everybody's grouped together with different ownership groups and buying apartment buildings, and they were doing syndications. But because the real estate market has slowed down so much, you're seeing more and more funds. You're seeing a lot of debt funds. You're seeing a lot of mixed funds where they'll call it a debt fund, but we also have the right to buy apartment buildings if we see the opportunity. So it'll be kind of a mix. So, I have a lot of conversations between, whether they should launch a syndication or a fund. And a lot of these folks haven't even raised capital before. They've raised very little capital. Now, the thing here is if you are stuck between those two and you don't have a ton of experience, a syndication is so much easier to raise capital into. So if you have a deal and you're actually buying, like, a syndication is just so much easier to raise for, because the investors can look, touch, feel the asset, what you're buying. They can underwrite it. They can make a decision based on the asset, the market, the deal, and you, of course. But it's a very informed decision for them to invest or not into your syndication, as opposed to a fund. You've got to build up a good amount of trust with your investors before they'll invest, because it's a little bit different, because you're going to raise the capital into the fund and then you're going to invest it into some deal down the road potentially. I mean, there's some nuances to that, but essentially it's either semi-blind or it's blind, and you're going to be making decisions on behalf of the investor to put their money in these different assets that they didn't even get to make a decision on, right? They made a decision on you and maybe the buy box, but there's a lot of trust there that you're going to make the right decisions with their capital. So it's a lot harder to raise capital into a fund than a syndication. So if that's kind of up in the air and you're not sure how successful you're going to be as a capital raiser quite yet, you don't have that confidence, syndication is going to be the way to go. And then maybe down the line, you pivot to a fund.
Thank you. So, I mean, I've been saying this for the last 6 years until I was red in the face. So anybody watching this video, if you don't believe me, you have it from Seth. So, yeah, because we call it the cherry pick objection, where if you offer somebody a fund, especially if they're sophisticated, they'll want to cherry pick some of the assets and then be like, hey, I want this, I want that, because it's like, why are you telling me what to do with my money? Unless you're a busy doctor or somebody who doesn't have time, and then they may not trust you. So I totally agree.
Right.
Totally agree. So Seth, if we were to take one thing that we want the audience to remember from this conversation from you, what would it be?
Yeah. I've been pounding this drum, and I mentioned it earlier before, but there's $65 trillion flooding into the private markets by 2032. And it is just a massive tidal wave of capital. And all of us that are listening or watching this show right now can be part of it, whether you're a lead sponsor, buying real estate or raising for private equity, or you're a capital partner that's raising money from your investors and investing that into somebody else's deal, or you're a capital partner in the deal. Either way, there's a ton of money ready to flood this market, and you need to be part of it. So stay up on AI, get your systems in place, get your pitch ready, get your compliance and your legal structure in place, get ready, because you are as soon as this real estate market specifically starts turning around, and that could be any time, it'll probably be in the next 2 years or so, it's going to be insane. It's going to be the people that, let's say, invested in 2010, think about those folks. You're like, man, I wish I would have started investing in real estate in 2010 before everything went through the roof. It's going to be the same thing. Real estate cycles are all the same. They tend to the last 7 to 8 years. The last one actually skipped the recession, and we went straight into a double session where we ran up for 14 years or so. Well, the next session is coming up, and you want to be part of it.
Yeah, I totally agree. And yeah, listen, this is Seth with Raise Law and Tribe Vest. And Seth, it's been amazing to have you. Thank you for
that too. Yeah, absolutely, brother. Thanks for having me on. Really appreciate you.
Cheers. And yeah, and where should everybody go? Just as we're closing, we'll put the links in the description, but just for the audience, just share the links for people to go to learn more about you.
For sure. I'd say the best way right now is I'm actually coming out with a book. So you can get on that list, and anybody on your show that signs up for the book now can get a free copy. So go to SethBradleyESQ.com/book. That's
it, everybody. So Seth Bradley, so that's SethBradleyESQ.com/book. And this will be in the show notes. So everybody, thank you for tuning in.
Thanks, Natu.
Cool.